Good morning, everybody. Welcome to another Market Report brought to you by Mike Bjork. Happy Friday to you all. It is Friday, November 6th. Hey, the big day today. The jobs reports come out today, so let's jump right into it. So we got the non-farm payrolls for the month of October, and as I indicated, we had just over 200,000 new jobs created up until around summertime. In the summertime, we were averaging right around, like here, last reporting was 137 back in September. We were kind of in that range. And the forecast is supposed to jump up to about 180, and it came in a whopping 271,000. That's the highest we've seen in quite some time, the highest definitely by far this year. It came out of nowhere and kind of surprised everybody, even probably even the Hawks people that thought the economy was doing much better than what it is. So as you can see with unemployment rate, that even improved. So we were forecasting 5.1 to continue at 4.1, and it dipped down to 5%. So this basically is a big indicator that really increased the likelihood of the Fed raising rates in December. So now the projections are well over 70% of the Fed hiking rates in December based on this information. So one of the concerns obviously is still inflation, but the Fed thinks that's going to improve over some time here. But again, it looks like the Fed probably will be raising rates here in December, as they've been really indicating and strongly trying to get the market to realize. And we'll see how the markets react here in just a minute. But right now, the last item here on the economic calendar is average hourly earnings. And even that was really good. People are making a lot more money. The forecast was supposed to be 0.2%, and it jumped up to 0.4%. So now the employment came in good. Our earnings came in much better. People are making more money. So good overall data today here. Again, it surprised the markets. The stock market's down today as a result, because basically that free money that they've been getting last almost decade now is basically looks like it could be going away with the Fed hiking rates here. And we don't. Again, the question is, once they hike it, is this going to be a trend that they're going to continue hiking down the road here, or that's going to be the next question once they get to that point. So be prepared for some more volatility even after they hike the rate, because you want to see where the economy goes. And when the Fed does hike rates, you also got a plan. It takes about a good 6 months before it kind of gets absorbed into the economy, where things kind of start moving. So immediately it won't really do a whole lot, but we won't see it until probably around summertime, around June, the effects of that hike in December. Bond market down. Remember what we said the last one was about 103.28. So as you can see, the tip went down further. It was on 103.19 and it pulled back. Right now we're at about 103.28 right now, touching the lows where we've been back around August, where we were before. And so right now, hopefully we've hit the bottom, and hopefully we could springboard from there. But again, this downward trend is putting a lot. This rate hike is putting a lot of pressure on both the stock market and the bond market here, and it's creating a lot of what's going to happen is you're going to have investors look at where they want to put their money. So a lot of money is being pulled out. Sometimes it's going into the treasuries as a even more safe haven compared to what the bonds are, until they review and decide where they want to put their money. But stock market could be going through a correction here very, very soon here, and that might help us out in the bond market. So they may put that in there. It's not as good as secure as treasuries, but it'll give them a little bit more what they want in terms of rate of return on their money. And we could see a little bit of a rally back into it. So we might get some of these lost ground back in there, especially when you look at how far we pulled off from the 25-day moving average, 200-day moving average. They usually have a way of pulling themselves back. It's kind of like a whipsaw. Once they get too far off from those lines, they pull back. And right now we're getting in pretty much probably an oversold position. So at some point we're going to spring back and probably get closer in line to where those lines are. Okay, you guys have a wonderful day. Thanks so much for watching. We'll catch you guys Monday. Enjoy your weekend. Bye-bye.